What you doing?
Talking about the opportunities in emerging markets equities with Stacy Mintz, head of quantitative equity at PGIM Quantitative Solutions.
What we're seeing consistently is that there is a lot more opportunity outside of the US. So if you look at our US large cap forecasted returns for a 10-year period, it stands at 6.2%. Whereas if you look at, for example, emerging markets, it's 9%. So that's a pretty big premium over US large cap.
But that just gets us going with the big interview today, because after that, we've got Jasmine Escalera, spokesperson for Live Career, which did research into how ghost job postings are a regular part of hiring strategies, meaning that people are posting for jobs that they have no intention of filling because they're not real. But oh, by the way, some of the people who are responding, they're regularly ghosting the people who are posting the ghost postings. And in the market call, Richard Howe, editor of Stock Spinoff Investing, is back talking about how to take advantage of spinoff situations. Yeah, that's what we're doing here today. This is Money Life for June the 24th. I'm your host, Chuck Jaffe. Thank you so much for joining me. We have a great show planned and executed for you today. We're going to give you some more emerging markets talk than we've had for a while, probably since we had Andrew Foster on the show, because that's where the research, for different reasons, right? Andrew Foster is an active manager, but he's not a quant. And Stacy Mintz is here, and these guys are quants. At quants, well, they're going to use what the system's telling them to use. That's what they're going to get for. Don't confuse being quantitative, relying on a system, for being passive, relying on an index, because that is distinctly not the same thing. And in fact, part of the research will show you that at times being more active can pay off in situations like emerging markets. But then the question is, are you the right kind of active? And being unemotional about it, well, that's why quantitative investing appeals to some folks. So that's what we are looking at, and I'm excited to do it with Stacy Mintz. The ghost job thing, oh man, this would just make me crazy, right? If you are looking at a job, and I haven't looked at job postings seriously in a long time. Every now and again, somebody say, hey, did you see this? Or I will see something get posted someplace and I'll look and go, oh, that's interesting that those guys are hiring. Or early in my career, that would have interested me. But if I were actively looking, or even just saying, hey, I'll take advantage of certain opportunities if they come up, and then you respond and you find out it's not a real job, I don't get it. I was a boss at one point, and I can understand the desire to make sure, I want to have qualified candidates ready to go. One of the things that I always told the people who came to work for me when I was business editor at the Morning Call in Allentown, Pennsylvania, is you're going to come in, you're going to work hard, and I will help you get your next job at a much bigger newspaper, et cetera. And we hired young folks who were anxious to go. I mean, they weren't all young, but we hired folks that were anxious to go, really wanted to work hard, really wanted to learn. And they knew I was going to make them crazy, working hard, trying to raise their craft, and then we're going to help them get the next job. And I always said, I didn't know when that would come up, so I always wanted to have an idea of who might be the next person to hire in my files. Now, it didn't always work out that way. In fact, I was always saying, let's look a little more to make sure we've got great candidates, but I wanted to know. So I can understand why a hiring person would say, let's go out and get some candidates just in case we have an opening. And yet, in the modern world where you can go to LinkedIn, you can do a bunch of different stuff, I don't really understand the ghost posting thing, and I think it would just make me nuts. So it's a really interesting interview, and I get it. It's not straight up money, but it is that life part of things, and it does affect folks. I mean, even if you think, well, I'm not in that portion of my life, you will be talking to somebody, and it's them or it's their kids or whatever it is who is looking for jobs. And this is one of those things that, this is good cocktail party fodder and whatever. And I will say that that's sometimes what we want out of our survey segments, right? Is for you to have that interesting thing and to tuck that statistic away so that you can use it. Speaking of interesting things, Man, the market was interesting yesterday. You had oil coming down. You had stocks rally after the attack, the missile attack in Qatar, from Iran to Qatar, because you then had talk of peace, etc. This is why you don't get too excited when you are looking at things and going, okay, hold it. There's a headline. How's it going to respond? Oh, do I want to go buy defense stocks because weapons were used? Well, you might, but you also might find out that, a day later that investment play is not necessarily an investment play because we're so quickly to peace talks. So, investing off the news is hard. It was interesting to watch how the market was responding as it was getting headlines and trying to sort this out in fairly real time. And all I'll say about that is, remember, when it's happening in real time, somebody's making money off of it, somebody's losing money off of it. But the people who are making the money are almost certainly the insiders, and the people who are losing are most certainly the folks that are kind of like, oh, I've got a little hunch. Let me kind of do this. There's your problem as an individual investor. But maybe you feel different. If you do, tell me about it. Chuck at moneylifeshow.com. I'd love to hear about you for that or anything else you got going on that is related to your money or your life. But right now, I bet you'd like to hear from our guests. Again, today's lineup is Stacey Mintz from PGIM Quantitative Solutions, Jasmine Escalera on the Ghost Job Survey, and Richard Howe from Stock Spinoff Investing. It's a great day to live the money life, and we'll start proving that with the big interview right after this message.
Everything an advisor needs in one newsletter. Go to advisorperspectives.com and see why 100,000 advisors are subscribed to our newsletter.
Welcome to the big interview on the June 24th edition of Money Life. Joining me now, Stacey Mintz. She is head of quantitative equity at PGIM Quantitative Solutions. If you want to learn more, it's PGIM, which is PGIM, pgim.com to learn about the firm and what they do. Stacey Mintz, great to have you here on Money Life.
Thank you so much for having me.
I love talking with quants. I know I'm a nerd, but I love talking with quants because it takes the emotion out of things. So it gives you the chance to kind of frame the questions and then find out what the numbers are saying behind it. As I always point out, if you're talking with an individual stock about individual stocks, you ask a quant, you say, what's your favorite stock? They say, I don't have one, but my computer tells me I like this. We're not talking individual stocks, and we're going to go in a bunch of different directions here, particularly in the direction of emerging markets because of some recent research that you guys have done. But let's start with the base case, because I'm not really going to ask you what your take is on it, but it's kind of more, what is the system telling us that you guys believe is happening with the market and the economy right now?
Well, thank you very much for having me, and glad to be talking to a fellow nerd if you like quantitative analysis. So really what we're seeing, we produce on a quarterly basis capital market assumptions, which looks at different asset classes and markets around the world to determine what the 10-year outlook would be. A lot of the volatility you're seeing these days is very short-term focused. 10 years is pretty long-term focused, but I think there's kind of a happy median there where we try to target with our equity strategies. And what we're seeing consistently is that there is a lot more opportunity outside of the US. So if you look at our US large cap forecasted returns for a 10-year period, it stands at 6.2%, whereas if you look at, for example, emerging markets, it's 9%. So that's a pretty big premium over US large cap. And a lot of that is actually valuation focused. So we look at not only the income that we expect from these different asset classes, the real earnings growth that we forecast for them, of course, inflation and some currency in there as well, but the valuation adjustment. And so what that's telling us is the US markets, which probably won't be surprising to you, are pretty richly priced. They're at over 21 times next 12-month earnings, which is in the 91st percentile. And in comparison, emerging markets are much more reasonably priced.
What the numbers can't show us yet is what's going to wind up being the impact of tariff policies and potential trade wars and the rest, and emerging markets in the middle of that, because even though I would consider China to be a developed market, it always gets labeled in and thrown in with the emerging markets. How, as a quantitative manager, can you guys look at the situation, I mean, do you just completely ignore that headline risk and figure it shows up in the numbers and that's when it gets factored in? Or is there any sort of damper that it puts on? How do we mix the art with science in a situation that's this fluid?
Yeah, well, that's a great comment about mixing the art and science. So when we're looking at where we see opportunities at a broader level, emerging markets, as I said, we're forecasting higher returns there. But underpinning that are some trends that we're seeing that actually will be a tailwind for emerging markets. So, for example, the dollar weakening. So the dollar's been historically strong, and a weaker dollar is actually helping emerging markets because a lot of emerging market economies have or companies have debt in US dollars. So as that dollar depreciating, their debt is becoming less of a drag on their balance sheet. We also look at opportunities, everybody's been looking to the US to capitalize on the AI boom. So that's where a lot of the mega cap companies in the US are, really getting a lot of investor appreciation. But if you look at EM, it can really benefit from the vet manufacturing piece of AI. So more than 70% of the hardware today supporting AI is really manufactured in EM countries. So Korea, Taiwan, and that really is a good tailwind for those economies as well. We also look at things such as just the performance of EM in general. EM's been underperforming developed markets for the last 13 years, and it tends to be pretty cyclical. But what's more important is when you dive down a little bit deeper and see that this has really been the highest discount that EM has been to the developed markets since the dot-com era. So not only have we seen this downtrend, but looking at the discount between EM and developed markets, you're seeing that this really could be an opportunity.
Is there a historical perspective in terms of, is there a time period where this is setting up and the last time we had these conditions, look at what happened to help set expectations?
Yeah, I think, the trend, like 13 years, it tends to be in roughly 10-year increments, but I don't think I would put too much weight on the actual time. History doesn't repeat itself exactly, but it rhymes. So what we do is we look at other elements within emerging markets. So in addition to having these opportunities at the EM level, we're also looking within emerging market stocks. So we're looking at this area. It's really alpha rich. There's a lot of volatility and there's a lot of information there for thousands of stocks at the real, the individual company level. So what we do in our portfolios at PGIM Quant is we build models that basically have all of our investment expertise in them. And what we're looking for are companies that have good growth prospects, that are high quality, and are reasonably priced. So if you think about it, we're really looking for the same thing most managers are looking for, even more concentrated to traditional managers. The difference is we're going to build models with all of our investment expertise and be able to apply them to tens of thousands of companies around the world. About 40,000 companies per day we come up with a fresh opinion on. In emerging markets, that's really important because you can build a diversified portfolio of many different stocks that you like for different reasons. So we can find fast growing companies that we think are going to really capitalize on their growth prospects. We can find another company in another area of the market that is really underpriced but high quality, and we think that that company will come to realize its valuation. So I think in this market, diversification is very important. And so our portfolios will hold a couple of hundred stocks of really good quality, good growth, and well priced companies.
We should point out, I think a lot of people will hear quantitative and they'll hear us talk about unemotional investing where we're digging into the numbers and they will
Mhm.
think that that means passive investing, et cetera. But this is anything but passive investing. And that's part of what the research shows as well, is that especially in emerging markets, you want to be more active, correct?
Right, right. So with indexing, you're buying the market, you're getting the return. So if EM does well, you will do along with EM. But really, when you've got these less efficient markets, buying an index fund, you're really leaving a lot of alpha or opportunity cost on the table because you can find the winners and the losers more easily in these volatile markets if you're an active manager. And also, trading in EM can be expensive. So, less liquidity, a lot more volatility. And so you really want to be able to get good value from the trades you're making. An index fund is just basically going to trade whatever needs to be traded to keep up with the index. You really want to buy companies that are going to more than compensate for the cost of trading. So that's one important thing. The other important thing is, although there's a lot of opportunity to find good companies in emerging markets, there's also a lot of risk. So you've got to be careful about taking large active positions in any one country or any one sector relative to the market, and instead look for other pockets of opportunity. So one thing we do in our models is we have kind of a top-down component to our investment model. So I talked about finding good quality companies with good prospects at the company level, but then also we want a top-down view to say, where are we seeing more pockets of opportunity? Where is sentiment really positive? Where are there pockets of more reasonably priced, overlooked companies? And so what we'll do is find country and industry combinations to give ourselves a little bit more exposure there. So, for example, you can't really look at emerging markets with a broad brush and say all the banks don't look good. Because if you look, for example, at Korean banks, our models are showing that that's an attractive place to put a little extra money, whereas Taiwan banks are potentially an area that you want to avoid. When you talk about China, you can look at China, and again, we wouldn't look at it with a broad brush saying China's good or China's bad, big overweight or big underweight, but instead we'll look at Chinese materials and say, yeah, really there's some good sentiment there and high quality, and it's a good place to put a little extra capital, whereas Chinese consumer services, maybe not so much. So the idea is to find little pockets of opportunity and take a lot of little tilts in these areas so you can get that alpha, but also control the risk.
How much are emerging markets right now benefiting from a dollar that has been weaker and getting weaker still?
Certainly has been, because the dollar denominated debt in emerging markets will become a smaller piece of their balance sheet with a depreciating dollar. So that's definitely a tailwind. Another tailwind that we're seeing is that the corporate governance of these EM companies has been improving. So historically, the real GDP growth rate for emerging market companies has been better than developed companies. However, corporate earnings haven't been as consistently good. And the reason for that is because there's been worse corporate governance in EM, poor capital discipline, deficient in shareholder protections. But that we see is changing. So there's more financial reform, better shareholder protection. So we're hoping that that higher GDP growth is going to translate into higher profits. And that's something we capitalize on in our quantitative models when we're looking at things like earnings growth and quality in general. We think quality is very important in a market like this, actually around the world, because as we have higher interest rates, inflationary pressures, more volatility, those lower quality companies are going to have a hard time surviving, frankly, or performing well. So when we're looking at growth stocks, we want to make sure that these are companies that are managed well and are high quality, because those are ones that are going to be able to capitalize on that growth. And similarly, when we're looking at more value stocks, we want to make sure we're not falling into value traps. So the quality becomes very important there as well.
You were talking emerging markets broadly and their value that they hold, and you did it relative to US markets. But for
Hmm.
a lot of investors, international is international. And for a lot of people who've
Hmm.
come on this show, the real question has been, do they like developed or do they like emerging? Because I don't find a lot of people who are like, yes, I love both right now. So I'm
Right.
curious. Obviously, your focus and some of the focus on the research you guys have been doing has been on emerging markets, but developed compared to emerging markets, just as you were talking about the U.S. being significantly less of an opportunity than emerging markets. Does the same apply in developed Europe?
To some degree. I mean, we're seeing that Europe in general is more reasonably priced than the US. And I think this year seeing a jump in the EFA index and strategies managed around that has been a positive. And again, it's investors diversifying away from the volatility in the US market, the prospects for lower growth and potential for inflation. And so they're looking to diversify. And, investors should always diversify around the world, but maybe you forget or you don't rebalance so much when the US is doing so well and you're kind of riding that wave. So I think the volatility this year has really had investors look all over the world, not just to emerging markets, to find other pockets of opportunity. And certainly in Europe, you're seeing that as well. So it was nice to see those markets do well. And our models did particularly well there because there were a lot of good opportunities that valuation played a factor in. So finding companies that were underappreciated for years are now seeing some inflows. So that's been nice to see. But our quality factors and our growth factors have also worked. So the alpha in those areas has been pretty strong. I think the difference is in EM, we see a longer ramp of, continued outperformance and alpha opportunities. And because it's inefficient, there's just more of it.
There was a point from research that you guys had put out earlier in the year, like months ago as we were around Liberation Day, where I swear it was PGIM research was talking about how the value dispersion that we've been talking about was at levels you hadn't seen this century. In other words, you were talking earlier and you just kind of reiterated the strength of emerging markets, relatively speaking. Is this a historic valuation to you? I mean, are we at a spot where those numbers you were talking about are, the best that a lot of people have seen in their investing lives if they're, under the age of 50?
The valuation spreads are at historic highs to some degree. I mean, I was mentioning the EM valuation relative to the US being the widest since the dot-com bubble. But I think it's hard to trade off of just pure valuation. Things could be very overvalued or very undervalued for many, many years. So I think it's more the catalyst of having real growth opportunities. And another example for emerging markets is diversification of the supply chain networks. So not having everything concentrated in supply chains in China, that diversification will help a lot of other areas like India, for example, which will start to get some more of that growth. So I think you have to look at the valuation and say, wow, this looks good, but then you also have to pair that with some indication that growth is going to, be favored in that area you're investing in as well.
Stacey, really interesting. I appreciate the time and the perspective. I hope we get a chance to chat again down the line.
Thank you so much. Thank you.
That's Stacey Mintz. She's head of quantitative equity at PGIM Quantitative Solutions. PGIM, PGIM.com if you're looking for more information. And if you're looking for more of Money Life for June the 24th, don't go anywhere because we've got much more to go, including Richard Howe from Stock Spinoff Investings. He'll be talking stocks in the market call. So stick around. This is Money Life.
Looking to earn CE credits and hear from top portfolio managers? Go to etftrends.com/webcasts and learn more.
Now Money Life looks at what the survey said. This is the survey said on Money Life. It's where we dig into surveys, studies, polls, any kind of research or data that's going to help us understand what people are doing for, with, and about their money. And today it's not so much about their money, it's about their jobs, and it's about looking for jobs. Because we are looking at a survey that was done for livecareer.com that looked at job postings. Now, I got to tell you that although I have a bunch of different hats that I wear, etc., I haven't formally had to look for a job in a long time. And everybody I know who has, which includes my oldest daughter who's been going through a job change, talks about how miserable the process can be. And that's under the best of circumstances. But finding out that ghost job postings are a regular part of some hiring strategies, like people posting ghost jobs, which I can only assume they're doing because they want to get resumes and candidates in for when they have a job open, but they don't have a job now. Yeah, I don't understand what folks would be facing if they're looking at this. And more importantly, I don't understand what you do in an environment where you don't know if a job posting is real or ghostly. Here to discuss it, Jasmine Escalera. She's a spokesperson for Live Career. If you find her on our guest page, you'll find a direct link to the study at livecareer.com. It's also in our show notes. Jasmine Escalera, welcome to Money Life.
Thank you so much, Chuck. And I'm excited to hear that your daughter's in the job search. She's going to do fantastic.
She actually has her first 2 offers now.
Yay!
And she was not ghosted. She's a teacher. The school that she was with eliminated her position, but she was highly valued, and she's got a good situation.
Oh, I love that for her.
But not everybody does. Ghost jobs would make me crazy. And I see job postings. Things come to me and I'm like, yeah, I'm not really looking. But the idea that I would go, hey, this could interest me, and I take the time to apply, and I do it in a timely fashion, because job postings these days kind of tell you, get your stuff in by this time or whatever. And then to find out it doesn't exist would make me crazy. So explain, what are ghost job postings and why are they part of people's hiring strategies?
Yeah, I think you have caught the sentiment exactly of what job seekers are feeling. So, ghost jobs are positions that are posted by companies that are fake jobs. They are not intended to be filled. And companies do this for a few different business strategy reasons. So, one is they may want to assess the talent pool, see what talent is out there. Another reason is because they want to show growth, especially now during potential recession. They want to show that their company is still growing. So they post these positions to say, hey, we're hiring. So companies do this for business reasons. But as you mentioned on the job seeker side, the job market is very competitive. There's a lot going on in the market. We have people who are waiting for jobs for quite some time. And to know that almost half of HR professionals admit to doing this is going to make job seekers say, well, hey, how do I even know if what I'm applying for is real? Do I even spend my time on this, or is this a complete waste, which is going to feel so disheartening to them?
Why can't the companies come up with something that says, we're looking for this kind of people for openings that may be available in the future? Now would be the time to get your resume. I mean, when I was a boss, we had very few openings, but as I was like to say, was the time to get me a resume was not when we had an opening. It was before we had the opening, so that I would go, oh, I've got great candidates right here and ready to roll. But I never lied to anybody to get them to apply.
Yeah, that would be the humane thing to do. And I think really because organizations are doing this potentially to show growth, potentially to show, hey, we're hiring, our revenue is good, we are great, we're still strong. They wouldn't want to necessarily say, hey, we have something coming up. There could be a variety of different reasons, but I agree with you. There should be a better way and a better strategy to assess talent, to show growth, than to basically trick job seekers.
The flip side of this is that there are plenty of the job seekers who kind of go off and post or throw stuff out there who are not really serious as well. Is that part of the problem here too? Is that everybody on both sides is just behaving badly?
I actually think for career professionals, it's a good idea to always keep yourself hot in the market. You want to see what opportunities could be out there for you to show your own self, I can grow within my field. So I think people, professionals who kind of say, hey, I want to feel out the market, I want to see what's out there, I think that's an okay strategy. When companies and businesses do this, you're actually thinking about it from the perspective of these job seekers are out here, they really want this work. And in many cases, they may really need this work. And so it feels very disheartening and it feels like tricking the job seekers when companies are doing this. When career professionals do it, it's really about, I want to see where my next potential possibility could lie.
Those career job seekers, I mean, there would be some advice for them, which would be, if you're going to apply for a job that you don't necessarily think I'm looking, et cetera, at least make it one that you could be really interested in. Like, when you're saying stay out there, make it, here's my career aspirations. Maybe it's the thing I don't think I could possibly get.
Yeah, I think you should always be looking for what's the next step and even stretch opportunities. Put yourself out there. I think it's great to do that. It also showcases how you can continue to market yourself. You should also always be networking. An opportunity can always come your way. So for me, it's important for career professionals to stay ready so they never have to get ready.
How much of this is an AI problem? What I mean by that is, are the HR companies basically saying, we'll use artificial intelligence to screen and do things along those lines? We'll throw a bunch of stuff out there, see what we come up with. But are they also getting responses from people that are clearly generated by AI, as in, write my response to a job about this, which means that there's a whole bunch of the transactional stuff here that is really two sides not serious?
So, AI can be such a helpful tool to use from a recruiter perspective, from HR perspective, and from a job seeker perspective. Of course, everything has two sides. It's going to be helpful, and there could potentially be components that are harmful. When it comes to the job seeker, it's super important to know that AI is a fantastic tool to use to build your resume, your cover letter, to help with applications, but it should never, ever, ever replace your own voice or personality or authenticity. And so it's essential that when you are searching for a job, you use this as a tool, but you don't use it to supplement your own voice, authenticity, or even to exacerbate any of your experience just to try to land an interview.
Is there another problem that comes up with these ghost postings, which is, if you're not serious about the job and I apply, I'm probably not going to hear from you. You're building for some time down the line, but you're apparently not willing to tell me that. So I'm going to apply. I'm not going to get a response or what have you, because if you're not going to formally reject me for a job that doesn't exist, are you?
Yeah, you're absolutely right. And that's why a lot of job seekers will say, I'm applying to all these positions and I'm not hearing anything back. And there could be a potential that that signals that that position was not actually available. It was potentially a ghost job. Or it could just signal that that specific company doesn't have a streamlined process to be getting back to applicants or some other thing. It's really important that when companies are hiring, that they really think about the person and the human they're hiring, but they also think about their process as a reflection of their company. So if you're not communicating back with applicants, that's a reflection of your lack of communication in general. And so I think it's really important that job seekers apply to positions that they feel are great fits to them. It's hard to tell always what a ghost job is, but there are some factors you can look into. And it's also really important for companies to notice how they are doing their hiring and to think about how it reflects our company and how it showcases us.
Yeah. And if you know somebody who's out there looking for a job and is frustrated because they're not getting responses, et cetera, maybe you want to point them towards this survey so they understand that some of what's going on out there, and it may not all be them and their job skills or what have you, that it may be that so many of these things are getting posted. Really, really interesting, look that we don't normally take. Jasmine Escalera, thanks so much for joining me on Money Life to talk about it.
Thank you so much, Chuck. It was such a cool time to chat with you.
Jasmine Escalera is a spokesperson for Live Career, livecareer.com. There is a direct link to the Ghost Jobs study that we have in our show notes and on our guest page. And I'll tell you what, we're not going to ghost Money Life. We're going to come right back. So don't ghost us. Stick around because there's more on today's show to go. So I'll finish my job if you stick around and do your job after this message.
Did you know that global generalizable robotics represent a $24 trillion investment opportunity? Top robotics and AI companies are actively reshaping industries across sectors. Learn more about capturing this investment opportunity at Vetify.com.
Richard Howe, the editor of Stock Spinoff Investing, is here. We're talking stocks and stock spinoffs, and it's market call time. Welcome to the Money Life Market Call, the part of the show where we talk with experienced money managers about how they do their job, what they look for that determines their buys and sells, what they see happening broadly on the market, and how they are putting it all together. Returning to the market call today, Richard Howe. He is the editor of Stock Spinoff Investing, which you can learn about at stockspinoffinvesting.com. Just run it all together. There is no dashes or anything in there. It's stockspinoffinvesting.com. We'll learn about the methodology and more. Richard Howe, welcome back to Money Life.
Chuck, thanks so much for having me. I'm delighted to be back.
So let's start with methodology. And for you, unlike a lot of folks, it has to start with a definition because there's a stock spinoff, which people understand. But there is an inherent question in that, which is how long is a spinoff so that it stays in your universe? And how long are the impacts that you think you might get from spinoff investing present in any spinoff?
Yeah, great question. So a stock spinoff, as most people probably know, is when a public company breaks up into two or more public companies. So a good example is GE most recently they spun off their healthcare business, they spun off their power business, and then the remaining business is an aerospace business. So that's a good example of a spinoff. And then in terms of how long I consider a spinoff, there's no hard set fast rule, but generally I like to cover spinoffs for 2 years since the date of the time that they go public on their own.
Is there a noted spinoff effect to you in terms of what you think will happen or what the typical spinoff should look like?
Yes. So typically what you see, and this especially happens if there's a big difference between the market cap of the parent company and the spun off entity. But if a big cap company is selling off or spinning off a small cap company, typically what you'll see in the 3 weeks when the company begins to trade is heavy indiscriminate selling pressure. And the reason that happens is because a lot of times index funds like index funds that track the S&P 500 and index fund that track other big indexes, and then mutual fund managers will own these large cap stocks, and then they'll get put a stock in their portfolio that is a small cap. And because their mandate is to focus on large cap stocks, they'll be forced to sell off those spinoffs. And so the thing that I really like to look at is I like to look at every spinoff that comes to market, do my work ahead of time to see if there's a spinoff or to see if it's a business that I would like to own at the right price. And then hopefully we'll see that indiscriminate selling pressure gives me and my subscribers a chance to buy the stock. And then as more investors learn about the stock and the fundamentals play out, then you look for that re-rating. But my ideal setup is buying the stock, within about 3 weeks of the spinoff. And then, typically over the next year to 18 months, the stock usually does quite well. Not always, but usually.
Yeah. So it's kind of, in some respects, it's a little bit of a reverse IPO kind of thinking because people want to get into the IPO thinking that they're going to get a big pop when, by the way, IPO stands for it's probably overpriced, but they think they're going to get the big pop. They want to come in. In this case, you expect to have the sell-off, and sometimes it's completely benign because beyond what you said, I know I've been in situations where like, really, I'm now going to have to account for these 7 shares of whatever got spun off of my round lot of this other company. Whatever it is, I understand going, let me just clean up the account and take care of this. So you wind up basically thinking the spinoff, it'll be hurt off the beginning. That gives you a better launching pad right after.
That's exactly right. And it's a great way to contrast to an IPO because the IPO is pretty much the opposite. As you said, it's sold by bankers. Bankers are paid a lot of money to sell and to hype up an IPO. Nobody is paid to sell a spinoff. It's just distributed. Whether you want this small little spinoff in your portfolio or not, you're going to get it. And usually the easiest thing to do is just say, hey, I got 100 shares of XYZ stock. I got 7 shares of the spinoff. I'm just going to sell this because I don't even know what they do. It's not worth the brain damage to figure out what they do. So that's exactly right. That's the right way to think about it.
How prevalent are stock spinoffs? I mean, if somebody wants to follow, can you build full, robust portfolios with enough things in there and then do the diligence and say, okay, let me find out if this is going to be the one that doesn't follow the pattern?
Yeah, so I'd say there's about, depending on the year, there's about 10 to 15 spinoffs that are worth following in the US. There's some little micro cap crappy spinoffs that I ignore, but I'd say there's generally about 10 to 15 spinoffs in the US that I follow and are generally pretty interesting. And then there's also periodically some international spinoffs that are pretty interesting as well. Can you build a portfolio of just spin-off stocks? You definitely could. I mean, that's kind of what I do. So I'd say 90% of my investments are in spin-offs or special situations. I'd say the majority of my investors or subscribers, they use spin-offs and other special situations to complement the rest of their portfolio. So maybe, they own Google and Apple and some other names, but then, for kind of the high juice, high octane part of the portfolio, they invest in some spin-offs. I would say spin-offs aren't really a part of the market where you can set it and forget it. Generally you want to be buying when you see that indiscriminate selling pressure. And when the market forces a re-rating, it's usually a good time to take profits. So it's not a stock. Spin-offs generally aren't stocks that you can just, buy and forget about.
Yeah. And that's a really interesting side too, because again, the spinoff winds up winding down. It was a key part of your motivation in buying. And for an individual investor, buying is what they focus on. Owning is what they do for a long time. And they're not always focused on the ownership side of things. And that's where, yeah, if a spinoff gets long in the tooth, you're not looking at anything. I would imagine that, as you point out, a couple years after the spinoff, it's still a spinoff, but it doesn't have any spinoff effect.
Yeah, exactly. The market, basically what I like to, how I like to describe is the stock has to stand on its own at that point, right? Fundamentals are going to drive whether the stock goes up or goes down. And what I like to do, what's so appealing about spinoffs is when I'm buying a spinoff that's being indiscriminately sold, I know that I know more about that stock than the person that's selling the stock, because the person that's selling the stock received it and they didn't want to buy the stock in the first place. And there are very few instances in the market where you can be fairly confident that you know more. You have a more insightful view on a stock. That doesn't happen too often. So that's what I like about spinoffs, and especially buying when there is that indiscriminate selling pressure. But you're exactly right. 1-2 years down the road, basically the stock has to stand on its own. So all the things that all your other guests talk about, margin expansion, revenue growth, market share gains, operational efficiencies, all that stuff is the most important thing. It's no longer really a special situation. It just has to perform well from a fundamental perspective.
Let's put it into brass tacks. Let's talk about a name or two that is kind of the poster child right now for the methodology, the kind of thing that you were looking at going, here it is. Or maybe it's the one that is coming that you haven't gotten out yet.
Yeah, perfect. Yeah, so there's two names that I would like to highlight. One is a name that I currently own and is really a poster child for what can really play out. So this name is called Net Lease Office Properties. The ticker is NLOP, and it was spun off from WP Carey, which is a publicly traded REIT. And the thesis here was WP Carey really wanted to get rid of their office exposure. Nobody wants to own office buildings in the aftermath of COVID and everybody moving away from offices and having everybody else work from home. So WP Carey said, hey, we're going to spin off all our office assets into a vehicle, and we're just going to liquidate that vehicle over time. And the stock sunk like a rock. So nobody wanted to own. First of all, it was like a small cap stock. It was spun off from a large cap stock, and it was focused on the office real estate market. And so nobody really wanted to own that stock. And so that was a great example to be able to buy a stock that is being sold off indiscriminately if you've done the work and taken a look at the real estate assets and seen that they actually generate a ton of cash. There's a lot of lease commitments going out 5 or 6 years at the time of the spinoff that gave you the confidence that even if these assets weren't sold at all, you were going to be able to collect enough rent payment to more than cover the current enterprise value of the company. So the stock has re-rated a lot higher. But I actually think it's almost a better opportunity today. When the initial spinoff took place, this company, Net Lease Office Properties, had 59 properties that they were in the process of selling. They've currently sold about a third of the properties, about 21 properties, and they've sold off they've paid off, I should say, all their debt that's associated with the company. And so any additional assets or sales are going to generate proceeds, which will be paid out to investors. And so I think that's going to be a very nice catalyst for investors once this stock starts to pay dividends. What do I think it's worth? I think net lease office properties trades for about $33 a share. I think they're going to start distributing capital pretty soon. And I think it's probably worth between $45 and $50 a share in terms of all the proceeds that could get paid out. And how long will that take? Sometimes liquidations take a very long time. I think within the next 1 to 2 years, the vast majority of proceeds should be sold off. So that is one example of a name that I like a lot. And then another name that I like a lot is called Lionsgate Studios. And so this was a recent spinoff that is currently in the process of being indiscriminately sold. It's basically the largest independent studio that's publicly traded right now. It's behind a lot of big movie titles like the Hunger Games franchise, Saw, John Wick, and some other high profile movie franchises. Lionsgate is a very monetarily focused business. They don't just make movies to make movies. They want to make a profit and generate some income on the bottom line. And there's a ton of strategic interest in studios. Most of them have been acquired. The most recent studio that was acquired was MGM, which was acquired by Amazon. But all these big tech players want to build out their studios. And so there's currently a bit of a bidding war for studios. And then in addition to that, there's also private equity companies that recognize that studios are a good business and they're actively buying studios. So I think ultimately Lionsgate is taken off the market. It has been, trading down sharply. It's trading, I think, below $6 right now. I think it's probably worth $11. And then the last thing that I would note about Lionsgate is that Steve Mnuchin has a firm, 77 Capital, that's bought about 15% of this company. He's a very well-regarded activist investor. And so it's nice to be aligned with Steve and his firm. And because I know that he knows how valuable the studio is and how much strategic interest there is from both large tech players, but also private equity.
Steve Mnuchin, no matter what you think of him, he did produce the Lego Batman movie, which we play sounders of all the time, but I'm not going to do that because it's time for us to find out how you feel about some stocks that my audience is particularly interested in.
Quick and dirty.
Man's got to know his limitations.
Well, you've heard Richard Howe talking about the limitations on stock spinoffs, but you want to know more about their potential? Well, he's the editor of Stock Spinoff Investing. You can go to stockspinoffinvesting.com to get more information. Quick and Dirty, of course, is our lightning round. It's where we put our guests to your test. You can do that and get involved personally by sending your name, your hometown, and the ticker symbols you're interested in to chuck@moneylifeshow.com. We start today with a request from Joe in Parker, Colorado. He wants to know about Solventum, ticker SOLV.
Yeah, so Solventum is a spinoff from 3M, and this is a very diversified business. At the time of the spinoff, it had 4 different underlying healthcare segments, one of which, the purification and filtration business, has been sold. But the interesting thing about this business is that I think there's going to be a lot more spinoffs that come from Solventum. Nelson Peltz is involved, and he's urging the company to spin off assets, to monetize assets. So I think this spinoff could result in several more spinoffs. I think the stock is attractive. It's trading at about 9 times EBITDA, which is cheap for a diversified healthcare company. I think it's probably worth about 12 times EBITDA. I think it's worth over $100. It's trading under $80 right now. So I would buy Solventum.
Sounds like the opportunity of a lifetime.
That's a buy on Solventum, SOLV. Sam in Woodbridge, Virginia wants to know about IGT, International Game Technology.
Yeah, so IGT isn't a spinoff, but what it's doing right now is it's in the process of selling its gaming and digital businesses to Apollo. And then the remaining business is going to be focused on the global lottery business, which is a very good business. And this, I would say, is definitely, while it's not a spinoff, it's a special situation. And the way that I think about this is I think there's a very high probability that the Apollo transaction closes. And then if you look at the cash proceeds that IGT is going to receive and you adjust the debt on IGT's balance sheet, you see that the remaining lottery business is trading at about 6 times EBITDA, which is a big discount to where the other publicly traded peers they trade between 8 times and 12 times. So I think IGT is a buy as well. I like that one.
I got a new game, sport.
Well, we're talking about the new games that IGT is getting into, also the games they're getting out of, but it makes international game technology a buy. Jeff in San Jose, California wants to know about Organon. That's a Merck spinoff that's OGN.
Yeah, so Organon has been a bit of a dog. So it is focused on the generic space and women's health space. And they've been levering up, making tons of acquisitions. And at the time of this spinoff, they said that they were going to grow revenue. Revenue growth did not happen. They had to rely on acquisitions to add revenue. At the time, they were going to pay a big, juicy dividend. That dividend only got juicier as the stock has got cheaper and cheaper. And so this is a name that I've avoided. However, Organon recently announced that they're cutting their dividend. So they reduced it dramatically, and they're going to use the proceeds to basically continue to pay down debt. And I think this is a very good decision. This is an extremely cheap business that is going to have to go through a bit of a transition because it's going from a big dividend player. So anybody that's in it for the dividend is going to be, rotating out of the stock. But the stock is extremely attractive. There are no massive patent expirations that the company has to worry about. And so this is a stock that I like a lot. It's cheap, but I think it's a turnaround potential. So I think it could have the potential to go up, 100% plus. So it's a little bit on the higher risk side, but I do like Organon. I think it's worth buying now that they've cut their dividend and they're focusing on paying down debt.
So a cautious buy.
Buyer beware, dude.
Because you got to know the warts and all on that one, but that's a buy on OGN Organon. Richard in Chula Vista, California wants to know about Esquire Financial Holding, ESQ.
So Esquire Financial is not a spinoff either, but it's a name that I like a lot. They are a law firm that is, or a bank, I should say, that's primarily focused on the litigation industry. And so in the banking industry, it's great to have a niche. They are the market leader. They serve the market incredibly well. They have a really good management team. It's a name that I've owned in the past. My only concern here is just the valuation. So it trades at about 16 or 17 times earnings. I would like to buy this thing. Historically, I've been able to buy it at around 10 or 12 times earnings. So this is a name that I would sell, and I would look for a pullback to add to my position. Love the company long term, but I think the valuation is just a little bit full today.
So currently a little bit rich.
And now for the profit taking.
But you are looking for that next opportunity.
I'm just taking my time before making the move.
That's all on Esquire Financial Holding, ESQ. And last, for Ted in Cincinnati, not a classic spinoff stock, that's for sure. It's Alphabet, or Google, Goog.
Yeah, so Google is not a spinoff, of course, but it is a big sum of the parts story. So if they were to break up and spin off their different assets, it would be worth a lot more than where it's currently trading. And so, like, if you just think of the valuation, their search and advertising business, it's worth maybe 800 billion to 1.5 trillion. YouTube's, could be worth as much as $1 trillion. Their cloud computing business could be worth almost another $1 trillion. They have Waymo, their autonomous vehicle subsidiaries, and they have a bunch of other assets in their company and on their balance sheet. So I think this company is worth, roughly $3 trillion. So roughly 50% ahead of where it's trading, even though it's not a spinoff. I think the stock is very attractive. One other thing to note is if there were to be some regulatory issues where the government or regulatory bodies were to force Google to break up and spin off its assets, I think that would be a major positive. And so I think Google is a buy.
So it may not be a spinoff stock, but it is a stock for which you're going to be watching for some potential future spinoffs from it and more.
I'm in this for the long haul.
And yeah, that's a long-term buy on Google, or Alphabet, Goog. And unfortunately, we go from long-term and long-haul buys to short-term because we've got to come to the end of our time. And that means we got to call this one off. But Richard, this has been great. Please don't stay away too long. I'd love to get you back on the show down the line.
Chuck, thanks so much. This was a lot of fun. Would love to be back sometime soon.
Richard Howe is the editor of Stock Spinoff Investing. StockSpinoffInvesting.com for more information. And we'll come back. We'll tell you where Richard agreed or disagreed with some recent guests on those stocks, and then we'll cross the finish line. This is Money. back to put a bow on this show. Thank you so much for sticking with us all the way through it. I hope you enjoyed that interview with Richard Howe. That was a lot of fun. And it's not the kind of thing we can do all the time because, yeah, spinoffs, there are only so many of them created, etc. But I really like the perspective. And it is one of those things where you should know. In fact, Organon, which he talked about in Quick and Dirty, well, it was spun off from Merck. And I had shares of Merck, still do, when it was spun off. So I got shares of Organon and then had to make the decision, was I going to hold them or not? And I've said on this show that I want to have everything be a meaningful position, that if I'm not willing to put in a certain amount of money, I'm not willing to own it at all. And there may be times where I put in my minimum and something goes down, but there comes a point where if I'm not willing to support it, I will get out of it. So I raised my minimum. It's something that I wrote about a few years back and that I think is important to do. As you get more money, et cetera, you don't want to have a million little tiny positions. So I basically said, let's raise the minimum, made it $10,000. And if I wasn't willing to put $10,000 in, I wasn't really willing to put $1 in. So here I got shares of Organon and I didn't have $10,000 in the stock because it was a spinoff and it wasn't that much. And ultimately I sold. Well, it was a sell today, so maybe that was a good thing. But Brian Frank from the Frank Value Fund, he was buying it back in February. So you do get different opinions and different takes, and you have to decide what you're going to do. And when you listen to that logic, you would go, hey, maybe if you get enough in a spinoff, you would say, should I make this a minimum position? Might not be a bad idea, especially when you hear Richard talking about things. You have to go to Quick and Dirty, where we did have crossover with Organon. But then we also had crossover, of course, with Alphabet or Google. Brian Mulberry, portfolio manager for Zacks Investment Management, was buying it on April the 10th. Matt Stuckey from Northwestern Mutual made it his poster child on February the 4th. Jeff Garbaz from Quantitative Partners made it his poster child on January the 30th. And it was the poster child for Max Wasserman of Miramar Capital 2 days before that. So it was the poster child basically 3 times in about a week. Plus, Dan Crowley from the Nightview Fund, well, he was neutral to negative on it on January the 22nd. We did not have John Kosar on the show because we have to reschedule him because he got stuck on jury duty, and we might have been able to turn it around late in the day and still get him on, but we said, let's not race and rush with that. But tomorrow on this show, I am super excited because Daniel Morris, the chief investment strategist at BNP Paribas Asset Management, will join us. And that should be awesome. I am hoping that lives up to my expectations. If it does, you will be happy too. Meanwhile, if you are looking for something to celebrate, today is National Patch Day, like, wear a patch or a badge, I guess. It's National Take Back the Lunch Break Day. It is International Ferry Day, and it is Swim a Lap Day. And I intend to do that, I think, because it's super hot and the pool was ready for me to at least get in a lap or two. On the food front, National Pralines Day. And my mom loved pralines, so pralines, however you want to pronounce it, it's okay with me, but I can't help but think of her on this day. On a lot of days. My guests today were Stacy Mintz, head of quantitative equity at PGIM Quantitative Solutions, PGIM, PGIM.com. Jasmine Escalera, spokesperson for Live Career, which is livecareer.com. And then Richard Howe, the editor of Stock Spinoff Investing. That is Stock Spinoff Investing, no dashes or anything else. StockSpinoffInvesting.com. Thanks to them. Thanks to Rob Floyd, my producer. Thanks to Maho, my dog. But mostly, thanks to you for being here, because you make this special one worthwhile for me each and every day. The Money Life quote of the day comes from Benjamin Graham, who said, "You're neither right nor wrong because the crowd disagrees with you. You are right because your data and reasoning are right." Well, that's why we want you to dig into the data, and we want you to think about the reasons, because that's going to give you confidence. And with that confidence, you can keep money in perspective, and that makes it easy to remember that until we do this again the next time, the best thing you could do for your money is not worry too much about it. Have a great day, everybody. Stay safe and calm. We'll see you here
The
again
people who
tomorrow.
appear on Money Life are here for your and their own entertainment. Don't take advice from us or any other podcast without doing more research and/or consulting your financial advisor. We believe our guests provide reliable information, but we can't and don't guarantee the accuracy or completeness of their statements. Opinions expressed on Money Life are those of the host and guests only and reflect their personal thinking. They're not representative policy or strategy of any employers or sponsors. This show is produced by Money Life Radio, which retains all rights to the content. If you want to use any part of this show for your own purposes, be they good or evil, you must get our written permission first. And remember, with great financial information comes great responsibility. Please act responsibly.
Go home, you losers!